All right, so again, welcome to the Asset Management Mastery Multifamily Meetup. We'll do some quick introductions, announcements, and then we'll get into a 42-unit case study, full cycle. So we just went full cycle about a month or so ago, and just really excited. That was our first acquisition that we did, and so excited to tell that story to everyone. And then at the end, we'll break out into some breakout rooms and have some networking. All right, so Robbie is going to still stay with MFM. So I think he's going to start doing some local meetups in Los Angeles down the road. But for Kyle and I, you know, if I'm going first, it's going to be pretty much the same thing for Kyle. Managing partner of APT Capital Group. I started investing in 2002. Lead sponsor on 4 deals. I've got 30 years of operational and management experience, probably longer than that actually now. I've been an entrepreneur my whole life. Co-host the Asset Management Mastery podcast and the Summit with Kyle, and we co-authored the book Best in Class, which will be coming out June 29th. So really excited about that. I hope you all get a copy of that, and the founder of the nonprofit Core Educational Services.
Yeah, it's exactly what Gary said, minus that last one there. And then I also co-host another podcast with my wife, Passive Income Through Multifamily Real Estate. We do have to take that principal multifamilymasters.com off my bio. We forgot to update that, but I'm no longer a principal or associated with Multifamily Masters. And I have about 15 years of experience in operations and management through my experience in the golf industry.
All right, so we do have costs, and thankfully we have some great sponsors that help reduce our costs. Garzella Group, we work with them for all of our insurance needs. We're actually doing some high-end flips in Manhattan Beach, and they're doing that. They're doing our multifamily. I've recommended to some friends, and they love them. They get the best rates. They're actually doing our workers' comp for us as well. So they cover everywhere in the U.S. and all different types of insurance. So definitely recommend them. Omar, he usually joins our group. I don't think I saw him tonight, but we can connect you to Omar if you have any insurance needs. Shelton Residential, actually. I need to update that as well, because they've been bought by Asset Living, and Austin from Asset Living, and will be joining us in a month or two, and talking a little bit about what they do. But they manage our properties, and they've been awesome. To the right, we have American Title Company. So we've used them on some of our purchases and some of our sales in Phoenix and Tucson. Then we have Bullpen. We use them for some underwriting and to come up with some different kinds of spreadsheets that we need and whatnot. They've been really good to work with, and they really understand real estate. It's not like going on Fiverr. It's kind of like going on Fiverr or Upworks, but they're specifically for, they really understand the real estate, which is really nice. Syndication Pro we use for our investor portal. And then Sense Financial, they have a self-directed IRA product, which is not like some of the other ones. This one is, they've got like a solo 401k as well, which I use. So if I invest in other people's deals, all I have to do is write a check. I don't have to go, fill out a million different paperwork forms and then wait, 3 weeks, 4 weeks, 5 weeks to hopefully get my money into someone else's deal. So I definitely recommend Sense Financial. All right, so hopefully you've heard of the Virtual Asset Management Summit, and hopefully you guys attended in September and October. We had over 1,800 people register for the event. We've got a stellar group going to be speaking at it this year again. Neil Bawa, Dan Hanford, Tom Wheelwright, Rod Cleave, Brian Burke, Hunter Thompson, Drew Niffin will be back, Ashley Wilson. So great speakers focused on asset management. This is a no fluff summit. So definitely check it out. To sign up, amsummit2021.com. And if you want to upgrade to VIP, that's $129, and that gets you all the recordings, and it also gets you the exclusive Q&A we have with the speakers every night, which is fantastic. It's just that alone is well worth it, because we had 15 people in a room able to ask any questions they want to the speakers, which is really cool. And we had that every single night of the summit. It's 7 days. And then, I know Ray's involved. We might have some other people that have registered for our asset management mastery course. This will eventually be all online for someone to get and use anytime they want. But right now we're live. We do it every Monday. And I don't know, Ray, you want to say a couple words about the course?
Impromptu. I'm getting a lot of value out of it. Finn.
Perfect. Awesome. Thanks, man. Any questions from anyone regarding the summit, the course, or anything else before we jump in? All right. So let me do a new share here. Well, you guys see it?
Yep.
All right. So we'll jump in.
Perfect.
Take it away,
all right.
Kyle.
So tonight we're going to go over a 48 units. This is the first property Gary and I ever purchased as GPs and sponsors in Tucson, Arizona. I actually drove by it today, Gary, looking the same. But we purchased this back about 2 years ago, and we just went full cycle on it just a month ago, as Gary mentioned in the beginning. So we'll kind of take you through how we found the deal, the business plan that was originally thought out and executed upon, how we pivoted, and kind of how it ended. And then I think at the end we'll have quite a few questions. So that's the part I'm looking forward to, is kind of the Q&A. Answer any questions on the things that we did, and then we'll end it from there and then do our breakout sessions. So this is exactly the conversation I had with the broker, how it went down. Not really, but back when we were first getting started, we actually drove to the markets that we were investing in. So Tucson was a 7.5 hour drive. Phoenix was about 5. On this particular drive, I was with my wife. And so we would leave at 2:30 in the morning. We would get there around 9 a.m. And the reason why we did that is because we had our full-time jobs and we could only take 1 day off, and we had to spend the whole day there to tour properties and then get back to work the next day. So we would leave pretty early. We wouldn't get home until 12 a.m. the next day. And on one of those drives, a broker called me and said, "Hey, Kyle, I know you're coming into town today." And as you can see over the left over there, they literally just got the listing to this property, and he was going to be out there checking the units. And he asked if I wanted to see it. It was 42 units. I said, absolutely. The good thing was that day our property management company was with us touring properties as well. So it was really a match made in heaven. We got to go to the property, see it for the first time before any other investors, got to tour it with our property management company, and actually got to tour the comps as well that same day. So we had all the information we needed before anyone had even seen it at that point. And so when we went there, there was quite a few things that we found as opportunities, which we'll go in later, but this is how we found the deal. And a lot of people can say, well, you were in the right place at the right time, but not everyone drives 7.5 hours at 2 a.m. to get to a property. And I think that's one thing that separated us from other people and allowed us to find this opportunity that ended up going full cycle and really from start to finish, a really great investment.
All right, so as you can see here, it kind of looks like a motel. Definitely lacked love. You really can't see in this picture, but the paint is chipping. The number here didn't even work. So I don't even know how they leased it up. As a first timer going into multifamily, I wasn't sure. And that's the beauty of partnering up with someone, because you're looking at typical well, I don't know what's typical, but like you know, when you're looking at a multifamily property, it doesn't necessarily look at like this, you know, because this is kind of like a motel style. Quite honestly, I wish we bought 10 of them at the time because it ended up being a, you know, a slam dunk and not a lot of competition. 42 units for our first one was a really nice spot because of the price and the size of it. You know, we can kind of get our feet wet. So it was a great find by Kyle and Lita. Yeah, see, you could on the right, you can see that paint chipping, but great bones on this property, and it just needed some love, and we'll get into it, but tremendous opportunity here. And you know, at the time, you know, we don't know what the potential that it turned out to be, but we were, you know, we had super conservative underwriting, and we hoped that it would be as good as we wanted it to be, and thankfully it did turn out that way, even better. All right, and see here you see the interiors. Again, the interiors are pretty good. It just needs some updating, you know, but not bad at all. It's in good condition here. You know, cabinets. I mean, the old cabinets, not pressed wood, they stand up really well, which is nice. It's that pressed wood that you don't want. So this was really good, and we'll show you the pictures for our rehab coming up, but. Like, you know, like I said, really good bones, needed a little bit of love, and it's a great market. And here are the interiors. So, you know, carpet wears out, so you're gonna, you know, change the flooring out. But other than that, you know, it's pretty minimum, which is fantastic. Keeps our rehab costs down.
Okay, so here's the opportunity. And one thing I might add, I think it might be on a future slide. Anyone that invests or looking to invest in Tucson right now, you know where the prices are at. We bought this at $39,000 a door, and I laugh at that now because it's insane. And we really should have bought everything 2 years ago. So 2 years ago, you know, 39K a door, and now prices are creeping up really close to 100K a door. And we'll get into what we sold this property for, but here was some of the opportunity that we found. So 0 advertising for the property, nothing at all. I went online, couldn't find it. Gary mentioned we called the number on the front, it was disconnected. And so literally the only way that you could lease up this property was to call the property management company that managed it, ask them if they had any available units at any of their properties, and then that property management company mentioning the one property. So this property was really struggling when we took it over. We bought it for 1.65 million, and the seller actually bought it for 1.7. So we actually bought it for less than she sold it for. They were using a single family home property management company. That's another sign. You know, they're just not equipped to handle multifamily. They don't have the systems in place. They don't have the scale. You know, 42 is still pretty small, but not as small as a single family home, right? And you do have to have systems and some infrastructure in place in order to execute on properties like this, mainly the oversight and management of renovations and rehab and CapEx. And so that's one opportunity that we took advantage of. Some of the units did not have rent increases for 16 years. So literally since 2003, I think it was, someone was paying $300 a month. And so another opportunity there. True value add, you know, a lot of people nowadays say this is a value add opportunity. I'm going to, you know, add washer dryers, bump up the rents $50. Is that a value add? You know, we can argue that. But it's not enough of a value add in my opinion. It's more of a game of hot potato. So this was a true value add, really driving up NOI by controlling expenses, adding value back to the residents actually, which we'll talk about later, and then also driving incomes. And then surrounding properties starting value add phase. So we knew other properties by doing our tours and our comps that day that they had just been purchased or they were renovating. And so that's a good sign because you know they're going to be pushing up their rents. The local neighborhood is actually improving. And so we really like the area. Kind of to add on that is that it was in a growing submarket in general, 2 Starbucks on both sides. Whole Foods just down the street next to some nice car dealerships. So we really liked this area. And I wish this area had larger multifamily because I would continue to buy in it. Unfortunately, it's made up of a bunch of smaller multifamily. And then solar was just installed. And this was a huge opportunity because I don't think the solar was priced into the sell price, but it was not accounted for in the savings quite yet. So solar was just installed in February, right? We bought it in May, but we had an accepted offer in that January, February. It was installed before February, but it didn't get turned on until February. So you had not actually seen any savings on the electricity on the T12. And so that's how the property was priced. But we knew we were going to save 20, 30% when we turned on the solar, and our electricity bill was going to come down. And so we were able to make those numbers work better because we adjusted for that. So that was an opportunity that I think was missed by the seller for sure.
And when we talk about she paid 1.7 plus the solar, that
right,
solar could have been quite a bit.
Yeah, so she's in for, you know, another, I don't know, $500,000 at least. Okay, business plan here. So our original business plan was just to update the interior upgrades. Gary, can you go actually back to the slide that showed the exterior? Yeah, if everyone can look, next slide. On the left there, you can see those are sliding glass doors. And our original business plan was not to change those out. The broker who sold this to us actually showed me a property that did it. It looked really good. And we decided to do it. Now that cost us $2,000 a unit alone. And that was the bulk, 75% of our rehab budget. And so we were really hoping that that strategy worked. It did, but it was kind of a gamble. But sliding glass doors was something that was a huge issue at this property because those are not just sliding glass doors. Those are like, I could flick it with my pinky and they would break. I mean, that's how thin they were. So really a huge safety issue for the residents. And people didn't like how you can just see through. So perfect, Gary, thank you. So we were going to change out the doors, did cost about $2,000 a unit to do. We added storage units. So there were just units in the laundry room that were just empty or being used for storage for the property. We ended up renting those out for $30 a unit. That never really took off. There were 6 of them. We rented 2 of them at one point, but it was a little bit of additional income for us. We added a barbecue area and a dog run, very small stuff. Changed out the landscaping. There was a lot of overgrown landscaping, a lot of cost to the landscaping because they had to be trimmed back. We went to more desert scape, so we didn't have to have a lot of landscaping costs. Fixed deferred maintenance. This is our #1 thing that we do at each of our properties. Fixing deferred maintenance allows you to lower your day-to-day expenses, right? If you don't fix deferred maintenance, you're going to have more leaks. You're going to have more calls on the HVACs, whatever it is, and that goes to your day-to-day operations and therefore affects your NOI. So we go in, we clean those things up and it helps your NOI, but it also relieves pressure off the staff, right? If your staff has to always fix the things for deferred maintenance, they're going to get worn out. You're going to need more staff. You're going to get tired of it. But if you can free them up so they can focus on the real things that are important, that's going to help with your culture, with their work ethic, with everything. So I highly suggest that. Increasing other income lines. This property management company who owned it before or had it before wasn't charging late fees, month-to-month fees, pet rents, or anything. And so that was a huge value add for us by just adding that. Increase rents to market and also add rubs. So they weren't adding rubs. We were at, when we sold the property, $48 for 1-bedrooms, or no, 48 for studios and 50 for 1-bedrooms. And so that was another huge other income line. We weren't sure if we can get the rubs, but a couple other properties in the local area were getting them. And so that's why we did it. Changing out property management, hiring a third-party property management firm that actually managed Class C value add multifamily. And that worked out extremely well. Expense management, there was just some expenses hitting the P&L that shouldn't have been in there, mainly by reducing deferred maintenance. Advertise, of course, so we were, getting an online presence so that people can actually find the property versus when we first found it, no one was advertising. And then rebrand the property. The property was actually Tucson East. Townhouse East is what it was called. And This is made up of 21 bedrooms and 22 studios. So there was no townhomes, and it was not on the east side. And so I'm not sure why they named that property that. So we rebranded it. Another reason why we rebranded it was because it just had a bad reputation. It just didn't have very good reviews. So we wanted to rebrand it. So we rebranded it to Midtown on 2nd. And so it's off of 2nd Street. It's in Midtown. We think it was a cool, hip name, and it worked out. And then lastly, the location, and I won't harp on this too much, but we love Tucson, Arizona, and we loved it 2 years ago. And these are older numbers when we were just first purchasing it, but all of them still remain true, which is why I like it. Number one in rent growth for tier 3 markets. In fact, they are number one for rent growth in all markets, including above number one markets like Phoenix. And so we absolutely love it. We've seen it. We've seen double-digit rent growth in this market for 2 years going straight. And it's going to be a third year where it's going to be double digits. Job, wage, population growth, all on an upward trend. Also job diversity, also higher paying jobs, which I love, right? So it's not just about job growth, it's about the right jobs. And you're seeing tech jobs come in. You're seeing jobs above $75,000 a year, which is going to raise the median income, which is going to allow more room for rent growth, which we really like. And then limited construction. And this was 2 years ago, and they still have very limited construction. If you look at a map on where they're building out there, there's not a lot of building. It's all around the school, and a lot of that is student housing, and the rest is Class A. And Tucson is a Class B and C type of market. And so there's going to continue to be massive rent growth out there because there is just no product. And so there's nowhere else for people to go. And so no building means, strong for existing multifamily. Growing submarket, we already touched on that. And then this property was located to all those things there, one of which was Basis Elementary. This is actually the number one elementary school in all of Arizona, and it was walking distance. It was just a block and a half away from our property. So really great location.
All right, so once we took over, like Kyle said, we worked on the exterior first. So we painted the property, and it just changed everything. And then the doors, and then we started working on the interiors. And people were, we were raising rents almost 50%, and people were staying. I mean, we kept raising it many times in the beginning of COVID, and getting it each time. But we did a really cheap backsplash here, inexpensive backsplash. It's
$30.
Plastic. Huh?
$30.
Yes. That beautiful Italian plastic tile on the left-hand side. It's stick-on, but I mean, it looks, via pictures, it looks good. And someone living there that's paying, $600 rent, it works for them, and it's nice. And, we didn't have to do a lot here. Like I said, we didn't have to replace cabinets, which, saves us $2,500, $3,500. They were good, solid cabinets. So if we had to paint them, we refinish countertops, maybe replace an appliance, some flooring, but really inexpensive upgrades for this property. All right, so after 90 days, let me move this here. These are the results that we got. All the exterior renovations complete, and we really like that, starting with the exterior first, because people will want to stay, first of all, and people driving by. It just, that's their first impression. And so Kyle and I like to focus on that first impression. We were receiving achieved pro forma rents on 100% of new lease ups since takeover, which was huge. It was great, right out of the gate, just able to increase rents and get exactly what we underwrote it for, and then keep pushing rents consistently. Like I said, through COVID, I mean, I think we raised rents, 7 times. It would be, a running joke when we had our property management call once a week, and if we were close to 100% occupied, she knew exactly what was going to be next, which was, okay, let's raise rents, and we kept pushing it to test, and if for some reason we didn't get it, we can always back it down. But want to keep pushing. You don't want to stay satisfied at 100%. And like this other person just wasn't raising rents. If it's going to cost more to live somewhere else, then why not push your rents and see what you can get, you know? And we also increased rubs. So we were getting $35 a unit in the beginning, and then like I said, we just kept raising that, and you know, we got, you know, after 90 days up to 98% occupied. So a little bit of work yielded a huge amount of results. You know, this property just needed some love, and we gave it to it. And we even got a letter from one of the residents who was really pleased about the work that we did. So that was really cool to get. You know, you want to make it a win-win. You want to improve the community for your residents, and you want to provide great returns for your investors. All right, this me.
I think this
So
is
what
me.
all right.
Is it? Do we have a picture of the exterior, Gary, on this or no?
No, I think
At the end, I want to show it for sure.
yeah, yeah, absolutely.
I have them up on my screen because the exteriors are really nice. So
okay, yeah, definitely.
The pivot, and this is where we do this for every property. You know, this was originally a 6-year hold, and after 8 months, actually, less than that, 6 months, we called the broker and said, hey, we're hitting all of our numbers early. What do you think? What do you think we should do? You know, it seems way too early to sell. We've got a bad prepayment penalty, which we'll talk about later. What do you think? Because we're done with our plan, essentially. All we can do now is bump rents and burn off our loss to lease. And so the biggest thing that we did, the key thing is we invited the broker to the property to take a look at what our finished result was. And he was impressed. And he said, I think you should add a premium unit. And so this was not something we budgeted for, right? So we had to find a way to find money. And luckily we ended up not spending 30 grand on railings because we got a credit from the seller. So they paid for that. And so we implemented 5 premium units. We started with 1, but we did premium units. And it cost us $1,200 to do what Gary's about to show you on the next slide. And we got a $90 rent increase. Okay, so that is, what is that? 90 times 12, 1,080 is what we make up. So it's a 14-month payback on your money. So it was a slam dunk. And if we would have kept the property for longer, we probably would have just kept implementing these. But why we did this was because we wanted there to be meat on the bone for the next buyer, right? So when you're selling a property, there is more value add buyers out there than there are turnkey properties, meaning properties that are just buy and holds, right? You're not going to be able to add value to it. So we wanted to position it as a value add, which is why we had this premium unit. We tested it and we got it. And so the goal there was then to do 4 more, which we did, and we got the rents immediately, and then listed for sale. So this is the renovated units as a premium. And so the difference is white cabinets. So that didn't cost us anymore. We just painted them a different color. We bought the stainless steel appliances. Okay, and there's no dishwashers or microwaves in here, so all we had to buy was a stove and a refrigerator, and then we changed out the cheap $30 backsplash for a real $350 glass backsplash, and then in the bathroom there, we just upgraded the mirror and upgraded the lighting, and that's it. This was our premium unit, and for just that, we were able to get $90 more per unit. Now, did we plan that? Can you do this every time? No, getting a $90 increase, even sometimes spending $8,000 a unit is not easy. So we really did find a diamond in the rough. It was just a property that was so below market. It was never advertised. And by putting those things into place and having the right property management company, we were able to execute on this. All right, so the sale, this actually fell out of escrow twice while we sold it. So it did take patience and the right buyer. And the reason why, and we're going to touch on it a little bit later when we talk about the challenges, but we didn't put good debt on this property for a short-term hold. Okay. And so I think when you're first starting out in the multifamily world, you want to be conservative. You're told to put long-term fixed rate debt. And the problem with that is that there's two types of prepayment penalties that are usually associated, not all the time, but usually associated with that type of loan, which is either a step down prepay, which is more predictable, and one that I would suggest, which is something like 5, 5, 4, 4, 3, 3, 2, 2, 1, 1. That's the percentage of the prepay that you'll have to pay. So if it's 5% on $1 million, you're going to pay, what is that, 50,000? $50,000 on a prepay. But if you get what's called a yield maintenance, you can actually get a 40, sometimes 50 basis point discount on your interest rate. Okay, so instead of 4.6 or 4.7, we got 4.2, which is very attractive when you're thinking about only the when you're not thinking about the end, when you're thinking about the cash flow and the current holding. But what that does is really kicks the can down the road. And what yield maintenance is essentially, it's a calculation it's not predictable. It's tied to the 10-year treasury. It's based on if interest rates go up or down, and it's also based on whether or as if you've paid off all the interest for the remainder of that loan. So if you sell in year 2, your yield maintenance is going to be a lot higher than if you sell in year 9, because most of your yield maintenance prepay is burned off. So if you're a long-term holder, yield maintenance isn't really a big deal because it's not going to affect you. But we never planned on selling this property in year, 1.5. And so our prepayment penalty at that time was $330,000. And that doesn't sound like a lot, but when your loan was 1.1 million, it's 30%. Our prepayment penalty was 30%. So we cannot sell it at $330,000 or a prepay at that, unless we got $330,000 more than what we wanted. So that's why we had to find the right buyer. The right buyer happened to be a 1031 exchange, someone that had to place money because of tax purposes. And we had to sell this property as an assumption. So someone assumed our loan, our existing loan, took our existing debt, added a supplemental loan on the back of it, and took over. And the downside of that is typically a higher down payment. So they had to come with more down. So that's why a 1031 works, because they're bringing in more cash. A higher interest rate because interest rates were lower at that point, and less interest only because we had used our 1.5 years of interest only. There was 3 years. So they took it over with, well, when they closed, about 1 year left on interest only. So those are the downsides. So that's why it fell out of escrow twice. We just couldn't make the numbers work. But we did find the right buyer in the end, which was a 1031.
And all that, we weren't desperate to sell. What we were, we knew we had a great deal, and the return on investment would actually go down the longer we held it, because if we got squeezed out all the value that we could right from the beginning, and holding it each year, we were at a really high curve up, and then it would just kind of flatten off because we maximize what we can get. So talking with the broker and our property manager, we thought it was the best time. So, when it fell out of escrow twice, it wasn't that big a deal. We had a great property on our hands, but if the right buyer came along, then sure, we'd entertain an offer. But here are the numbers: purchase price 1.65 million, rehab only 200,000, and a sales price of 2.8 million. So great return for our investors. Like Kyle and I said, we wish we bought 10 of these, hindsight being 2020. But this was the first one that we purchased, and obviously going into it, you got to see it through to gain that confidence of implementing a business plan and seeing everything come to fruition. So, and this played out perfectly for us.
All right, so for We do have some questions, but we'll take those in a second. For the lessons learned, I did talk about the prepayment penalty, so I won't beat that anymore, but please be careful about your prepayment penalty and begin with the end in mind. Don't kick the can down the road because it will end up hurting you. We have another deal right now, same thing, high prepayment penalty, and we're trying to figure that one out. But the first one there, the lender, build a good relationship and a rapport with your lender. We had a mortgage broker who unfortunately tried to take advantage of a group that was doing their first deal. Added fees that weren't disclosed, changes last minute, additional funds needed from the buyers. And so we actually broke ties with them and said that, we didn't feel comfortable working with them anymore because we thought we were being taken advantage of. We bailed on them 29 days before we closed. And so that was pretty scary for us. It was our first deal. It was on the borderline of not being able to close. We had used all of our options as far as extending it. The seller was done allowing us any extensions. And we called, it was a Hail Mary. We called a broker or a lender direct. In fact, he was in New York walking off a cruise. It was 10 p.m. at night on a Friday. It was 7 p.m. here. And one of our other partners just called him on a whim. And he answered and he said, I can do it. And they closed on the last day and the last hour and the last minute. And we got it done. And one thing that really happened, what was really great is we got a huge basis point discount. I don't even remember what it was anymore. We got a 4.2 rate. And I think originally we were quoted at 5. So by switching lenders, we actually got an 80 basis point discount, which was huge for this deal. But we didn't plan it out that way. I never suggest changing horses at all, but even in the last 29 days, because typically it takes 45 plus days to get a deal closed with Fannie or Freddie. And then renovations and working with residents. One thing that we really learned is that we didn't plan out the renovations like we probably should have, that we could have done better. We were done in 90 days, which sounds amazing, but we changed out the doors. We then painted. Then we replaced all the railings. Then when you look at the doors, we didn't think about all the glass in the doors and how people could see through there. So then we had to go back and install blinds. And so we were impacting a person's home 4 separate times. And during those 90 days, people really kind of pushed back. That letter, actually, if you read it, said at first it was a nuisance, and then they ended up loving it when it was done. What we could have done is just planned a little bit better to do things more cohesive and all at once, so it impacted the residents maybe twice versus 4 times. So when you're doing renovations, always think about it from the perspective of your resident. How is it going to impact someone's living situation, right? This is their home. This is where they live every day. And you've got to remember that. And I think it's important to be sensitive to that. And, we ended up having a lot of retention. We had 16 months out of the 42, 15 ended up staying. So people really loved what we did, but we could have definitely done a better job in that situation.
All right. Hey, you want to pull up that picture of the exterior?
Yeah, let me pull these up.
All right. And we do have some questions, so already in the chat. And
here's the exterior. So as you can see, we went bright on it. My wife, Lolita, actually picked these out. I think they turned out great. She's not listening now either, so it's not just for brownie points. We went Midtown on 2nd. We actually painted the logo on the wall on 2 different walls, and I think it looks really cool and hip. And then you can see the doors here. And you can see those are the windows. And at first we didn't have those blinds. So people didn't like it because everyone could still see through. So, but we changed those out, and it really changed the look and feel of this property. And then we also redid the railings here, which were not up to code. And so we got a $30,000 credit from the seller, actually, because they were supposed to do that beforehand. Let's see if there's any other pictures.
so, as you can see, a nice coat of paint just changes the whole look tremendously. When you drive by, from the previous picture to this, what a difference. You want to live in a place like this. You don't want to live at the other place,
Yeah, that's it.
All right. So we'll take questions. I know Ray, you said what the holding period originally was underwritten for 6 years, but we ended up selling it under 2 years.
23 months. How do you decide how much meat on the bone to leave for the next owner? Yeah, great question. So we typically talk to the brokers about that. You know, right now, I think the rule of thumb is about 50% in the Phoenix market is what you're seeing a lot of. But I think it just depends on where the market's at. The reason why we only did 5 units on this one was because it's a smaller property. And so you need more value to really add. And there wasn't much other value to be added, right? So our expenses were tight. So no one could save on expenses. Our other incomes were high. So no one could add other income. So the only value add for this property was increasing the rents $90. But if you have another property where, okay, you can add rubs, you can add parcel pending lockers and charge 14 bucks a person, you can lower your payroll by 10 grand. Now that's more of a value add because you're driving more income to the NOI. But it's a balance, right? Because the numbers need to work for you. And the more money you're putting into the units and raising the rent yourself, the more NOI you're going to get for yourself. So the higher your returns for your investors are going to be. But there just needs to be some meat left on the bone. I don't know a rule of thumb. You know, we focus on when we're underwriting right now, 50 to 70% of the units is what we're trying to renovate and leaving that 30 to 50% for the next person. And, you know, in today's market, I'll be honest with you, if you did 100% of the units and then just did a handful of new premium units, or, you know, if you hold on to a property for 3 years, people think that that's outdated and there's value add there. I mean, that's how quick this market's really moving. So there's always a way to get around it, but you always want to try and find an exit strategy where there is some meat left on the bone for the buyer, for the next buyer.
Right.
What was your
Gene asked-
projected? Yeah, what was your, we can share the projected, we can't share the actual. The reason is because we do 506Bs, okay? So we're not hiding anything. If you want to schedule a call with us, I'm happy to share those numbers on a personal call, but we can't advertise it. And this is actually going to be posted on our YouTube channel, so that's why we can't share it. Our average annual returns were projected right around 15%. The IRR was actually under 15 at 13.86. And this was offered at a 6-pref 80-20 split. We do different splits now. And the cash on cash was around 7.5 is what the projected returns were. But that was for our first deal. And we had to raise $1 million for it. And we've changed our structure a little bit since then. And again, I'm happy to schedule a call and talk to you about the actual returns.
What other questions you guys have?
And feel free to unmute yourself too if you want to just unmute and talk to. You're more than welcome to.
Hey, can we talk about the seller a little bit? What motivated this seller to sell, and why did they miss the solar opportunity? They installed the solar, but from what you said, they didn't take advantage of it or wasn't in the numbers. What happened?
Yeah, well, 2 things. They didn't take advantage of it. Number one, because if they held the property for 3 more years, they actually get tax credits. So they installed it and then sold it. So it was kind of a waste of money. And to be honest, it was just a unsophisticated seller, you know, based in California, had 2 properties here. We actually tried to buy their other property and got outbid. Just someone that wanted to unload it because they were having trouble with it. They hired the wrong property management company. They didn't know what they were doing as far as the managing those people. And like I said, the phone number is disconnected, right? There's no way to rent up. I mean, that is a huge sign. And so you just, you don't have someone that is educated enough on running a business. And I always say it, you are running a business when you buy a multifamily property. And if you just don't know that side of things, you can lose pretty quickly, you know. And she bought it in 2008, and so obviously the next couple of years in Tucson and Arizona in general struggled a bit, and so I think a lot of cash flow kind of got sucked away in that process.
So bottom line, absentee seller who thought the property would run on autopilot, and it didn't.
Yep.
Okay.
And they didn't. This is the weirdest thing too about this property. They didn't put any money back into the property until they sold it. And so when we bought it, we thought there was 18 renovated units that actually ended up being 23 renovated units. So she did 5 more than she needed to. She just kept renovating units while we were in escrow. And we're not going to argue with that, right? Because at $3,000 a unit, we saved $15,000, and on a 42 unit, that's a lot of money, not on these larger ones, but, and so that's kind of like just bad decision making, right? Why would you do that at that point? At that point, you're just trying to spend as little money as you can because you're locked in for a purchase price, and then you sell the property. So it just seems like they did it backwards.
Which is a perfect segue into the next question from Gene. What is involved in asset management beyond managing the manager? And that's what Kyle was saying the other owner did. I mean, they weren't even managing the manager, but an asset manager knows their market, visits the property, visits the comps, has a feel, and is pushing the property management company. It's a lot of trust but verify. It's spot checks. It's communicating with a broker and your regional property manager. And what can we do? And we're constantly, Kyle and I are constantly visiting the property and talking to our team and coming up with ideas to keep pushing revenues, keep minimizing expenses when we can, when it's reasonable. So we're constantly trying to improve the property every single week, every single month, and little tweaks will keep adding up. But you can't fall asleep in the wheel. Just because our property was performing well didn't mean we weren't having our weekly calls, didn't mean we weren't looking at the reports, because we could have easily, if we wanted to fall asleep, we drastically improved the rent and this and that, and it's on autopilot. No way. You put it on autopilot, your team starts going on autopilot as well. So
yeah, I'll add to that too. Single family home, they had a single family home property management company. If you know anything about single family homes, how many times do you think a property management company goes to your single family home that they're managing? Once a year, maybe, for a yearly inspection, right? And so my guess would be that this owner wasn't even having weekly calls, if even monthly calls. And this property management company wasn't even going to the property once a week. They have part-time staff maybe. And so it starts with hiring the right property management company, and then all those things Gary said as far as managing them. So you do have to keep your eye on the ball. These things cannot be put on autopilot if you want to get the best results.
And even with this property performing extremely well, there were a bunch of times where Kyle and I had to put their feet to the fire on some things that were maybe slipping, that things weren't getting done in time, or filling it up. I mean, there were things that we just there were areas of improvement, and we were constantly looking to improve our bottom line. What other questions do you guys have?
I just want to say I really like the new doors. They really add a lot to it.
Cool, thank you.
Yeah, the sliding glass doors. I mean, if they had a rear yard and that was, for it, great. But for a front door, not so good.
What is your sweet spot now for a number of units? We really like that 100+ unit space, although we just bought a 93 unit a couple months ago. So we're not against that, a little bit lower unit count. But the reason why 100+ is typically those can support full-time on-site property management. So we have a manager on site and a full-time maintenance person. So they're literally there 5 to 6 days a week. At this 42 unit, we only had part-time maintenance and part-time leasing. And there were certain points when they would only be there 2 days a week. And so no one is there to keep an eye on your property, every day, like we were just talking about. Even with good property management, it also has to do with how much payroll the property can withstand. And so we like 100+ because we'll have someone on site all day long.
Yeah. This was a small deal. We went from a $1.65 million purchase to a little over $15 million purchase on our next deal, and that was 128 units. But no matter how big, how small, just start somewhere and learn, and then you can go from there. Any other questions? Otherwise, we can jump into breakout rooms. All right.
All right. We'll do one session in the breakout rooms and then call it a night. Let's see here. create. Let's do 3 breakout rooms.